Good morning, options traders. Well, I thought it would be helpful to pass along another helpful tip here called relative pricing. And it is something that professional traders know all too well, and it's exactly what it sounds like. Can we tell if, let's say, one strategy is priced better than another, or one set of strikes compared to another, or one expiration date compared to another? So by relative pricing, what we mean is I might not be able to tell you if it's cheap according to a pricing model or even expensive. But what I can tell you is, let's say that strategy A is priced cheaper than strategy B. And that's still really good information. And remember that better decisions will always lead to better performance. So let's take a little deeper dive into relative pricing. One of the reasons I like talking about relative pricing is it shows the importance of strategies. And sure, strategies are beneficial because traders can select specific risk-reward profiles. That's the main reason that we use strategies. But strategies can also be used to make pricing decisions. So again, this is why it's important to know all of the strategies. I hear too many times that traders might say, well, I don't really have a use for butterfly spreads, so I'm not going to learn them. Not a good idea. They can help you make much better decisions, let's say with your vertical spreads. So again, are there strikes with better prices, expiration dates? How can we tell? This is where we get into relative pricing. And a nice little trick you can do if you're comparing strategies is to make expiration today. So for example, let's say that we're looking at some vertical spreads and we see the $95 call trading for 7, the $100 call trading for 4, and the 105 call trading for 1. Is there anything that we can say about these prices? Well, that depends on where the stock is. Let's say the stock is up here just a shade above this 100 strike, trading at 101. Now we've got some really good information, relatively speaking. Take a look at the 95-100 pair over here. If we buy this vertical spread, I'm going to spend 7 for the 95 call. I will receive 4 for the 100, and that means I'm going to spend 3. Well, what about the next pair, the 100-105 vertical spread? If I buy this, I'm going to spend 4 for the 100. I will receive 1 for the 105, and again, it's going to cost me $3. So they both cost the same. They're both $5 spreads, but what do we know? Well, if expiration were right now, let's say in the next 10 seconds, the 95-100 pair would be worth $5. They're both in the money. The 100-105 pair would be worth $1. And that's because the $100 call would be $1 in the money. The 105 call is out of the money. So think about it. If expiration were right now, and I can tell you for sure the 95-100 vertical spread is more advantageous or more favorable compared to the 100-105, that tells me that that must also be true right now. So as I mentioned before, I can't really tell you if the 95-100 vertical spread is, let's say, relatively cheap compared to a pricing model, or if the 100-105 vertical spread is. But what I can absolutely tell you is that right now with the stock at 101, the 95-100 vertical spread is absolutely, relatively speaking, cheaper. And that would be the better set of strikes to buy. Now, there's another way that we could look at this, and that is with butterfly spreads. If we understand that the butterfly spread is simply two vertical spreads, what have we got here? Well, I could buy the 95-100 pair for 3, and I could sell the 100-105 pair for 3. That's the butterfly spread. I would be long the 95-100-105 butterfly, but it would cost me nothing. So if you could ever get into a butterfly for no cost, do it. It cannot hurt you, but it might make money. So in this example, this would be our risk graph. Notice that no part of the graph falls below 0. So again, we cannot get hurt, but if the stock closes somewhere between these strikes, between 95 and 105, we will make something. With the maximum being right here, $5 gain if the stock closes right at 100. And that's just the difference between these strikes, between the 95-100 and the 100-105. Those are two $5 vertical spreads. and that's why the maximum gain is 5, and because we paid nothing, we would in fact keep the full $5. So again, I think it's just so important to see how vertical spreads and butterflies can be used to help you determine which set of strikes are priced relatively more favorably. And if you're making decisions with more favorable prices, that means better profits in the long run. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.